How's it going to affect us all? And could there be more on the way? Our economics and business editor, Liam Halligan, is here with us because, Liam, we are also getting the quarterly forecast, looking at the road ahead. The Bank of England saying the UK could be on course for its longest recession since reliable records began a century ago. It's not looking good.
Yeah, let's be really clear about what's just happened. Rates are now at their highest since 2008. It's the sharpest increase in rates since Black Wednesday 30 years ago. This is expected. The Federal Reserve, the US Central Bank, raised its interest rates by the same amount yesterday, the fourth successive time in a row it's done that. It's the first 75 basis point rise by the Bank of England, though. And this is clearly an attempt to really squeeze inflation out the system. Inflation is 10.1% on the latest numbers for September compared to September 2021. And it will mean that savers get more money when they make their deposits at banks. And a lot of older people live on the interest from their savings, of course. But many people who are younger, particularly young families who might have bought their first home, their mortgage rates will go up. And as an illustration, Mark, if all this rate rise is passed on by the mortgage lenders, which it almost always is, it's in many ways it's not a particularly competitive market, then if you've got a £200,000 mortgage, then that will mean an extra £85 a month on your interest bill to service that mortgage, which is just over £1,000 a year.
Yeah.
These payments made out of your post-tax income, of course. So £1,000 of post-tax income is pretty chunky for somebody on the average wage.
And now an indication there could be yet more to come to try and actually choke off inflation with a recession. And this is obviously puzzling a lot of people. If there's a recession and we haven't got the money going into the economy and swilling around, which pushes up inflation, how effective are these interest rate rises going to be in putting that foot on the brake?
Well, interest rates are a very, very, very blunt instrument, and they need to be wielded early and with attitude. And the problem is that the Bank of England hasn't moved nearly quickly enough. It should have been doing this months and months ago, as some of us were writing at the time. Then interest rates could have risen by less to squeeze out inflation, because inflation wouldn't have become as embedded. There is some good news here, though. Over recent days, government borrowing costs have been falling sharply. It's partly because we've got a new Prime Minister and Chancellor who seem to be a bit more willing to mollify financial markets and put forward the idea of raising taxes and slowing down the rate of increase in spending. So those government borrowing costs are coming down. And it doesn't seem that inflation expectations are coming down as well. So interest rates, some people thought they were going to peak at 6.5% just a few weeks ago. It's now looking like more of a 4.5% to 5%.
Right, and Ben Broadbent, the Deputy Governor of the bank, picked that figure 5%. But when do we think that would happen? Because clearly if people are trying to juggle their household finances and work out what to do about their mortgages, if they know there's a little bit of light at the end of the tunnel next spring, then they can work accordingly. But at the moment, it's a really gloomy picture for them.
It is pretty gloomy, and the Bank of England, of course, as you said, is saying that it does think the economy is already in recession. We were saying that earlier this week here on GBNews, looking at some of the survey data, particularly the manufacturing sector. Look, there are around 11 million mortgages outstanding in the UK. 8.5 million of them are on fixed rates. But the thing is, when you're on a fixed rate for 2 years or 5 years, that time can expire, and many people are coming to the end of a 2-year fix. The good news is that the rate at which they renew their fix will be higher than it currently is, but it won't be as high as we thought it would be just a few weeks ago, because those government borrowing costs have calmed down, and the Bank of England will probably not raise interest rates as much as we thought we would. But I'd say the peak in interest rates, as far as the Bank of England is concerned, will probably be sometime in the middle of next year.
Right, so we've got more to come.
Yeah.
What about the mortgage market then? I know John Charcoal, one of the big mortgage brokers, is saying, the potential lower rates are not potentially being passed on, because obviously they're sitting quite understandably on their hands waiting to see how these things go, because clearly people have got to make decisions now if they're coming to the end of those fixed rates and trying to work out what do we do for the next 5 years even.
Well, the only thing that keeps big financial companies honest really is competition, and there's a lot less competition in the mortgage market than there has been in recent years, unfortunately. It's a bit like when oil prices go up, Mark, the petrol retailers instantly put the price of petrol and diesel up, but it goes up like a rocket. But when oil
like
prices come down, they come down like a feather. Yeah. And I think it's similar in the market for finance. These are big companies. There's not enough competition. So I do think it will take the mortgage companies some time to react to these lower interest rate expectations. But for now, it's clear that interest rates are going up, and we can only keep our fingers crossed that does finally squeeze inflation out of the system.
Yeah, and that's not, it's affecting business as well, because they have to borrow.
Absolutely,
massively, yeah.
Absolutely.
Liam, for the moment, thank you. More reaction, of course, as we get it. But